a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The new tariff list unveiled. U.S. rates on goods across the world set to rise to the highest level since the 1930s. Jobs Day in America. Traders await the data for the latest clue on where the Fed goes from here. And a mixed bag for tech. iPhone sales lead Apple to strong results, but Amazon underwhelms. So you take all of those things together, and it's a pretty negative start to the trading session for your futures this morning. We are weakening as we go on. S&P down nearly 1%. NASDAQ 100, that underperforms with, again, Amazon, some disappointment. Valerie Teitel will walk you through those individual names in a moment. We are on track for a fourth consecutive day of losses. And by the way, before we had those losses, we were hitting all-time highs. So here you go. Here's your start to August. Maybe not the summer you had planned. Meanwhile, for this bond market, it was stronger data yesterday, and it is all eyes to jobs at 8:30 a.m. Eastern. We're lower by a basis point on the front end. 10-year, 30-year yield, those that'll change. Expectation for today, by the way, is 104,000 added and a 4.2% unemployment rate. Let's get you those stocks on the move this morning, including the big tech. With that is Valerie. Hey, Val.
Good morning, and Danny, happy Friday. Happy Payrolls Friday, too. Yes, let's start in big tech with Amazon out with results after the bell yesterday. Some disappointment when it comes to its guidance around the AWS, its cloud service businesses. I think this gives a good reflection, Danny, of if a company can't back up this CapEx spending with a solid core business, it seems to get punished in trade. So Amazon down some 8%. Over to Apple, it was a bit rosier picture. They beat in iPhone sales for the previous quarter and gave some solid guidance for the quarter ahead. They also had some color on their tariff costs. They noted that their current quarter tariff costs are around $1.1 billion. It seems like investors don't mind that big number. The shares of Apple are up 1.5% in pre-market trade. Lastly, let's end with Coinbase. This was another earnings report. Coinbase being the largest U.S. crypto exchange. They did see a decline in revenues disappointing estimates, and that's due to the fact that there was lower volatility in crypto assets. So Coinbase down some 11%. But note, Danny, this stock has rallied over 50% to start the year. All this optimism around the deregulation in the crypto industry, a lot of optimism has been baked into this stock. Danny.
Valerie, thank you very much for that. We'll catch up with you later this hour. Also in this hour, great show for you. We're going to talk trade with Nico Fitzroy of Signum Global Advisors. Veronica Clark of Citi will join us on the jobs report. And finally, Joel Kulina of Wedbush will join us to talk about those big tech results. But our top story this morning, President Trump sets a 10% minimum global tariff. Imports from countries with trade surpluses with the U.S. will face duties of 15% or higher. Bloomberg's Brendan Murray leads our global trade coverage. He joins us now. Brendan, I don't even know where we start. So many different figures coming out. What has been your big takeaway from the flurry of trade announcements we've had over the past 12 hours?
Yeah, it's a real patchwork of different tariffs with two real baselines, the 10% and the 15%. The 15% is going on about 65 countries that have those big trade disparities with the United States. Some of the standouts, there was a big surprise for Switzerland, a 39% tariff. India, as we've seen over recent days, is getting the 25%. Canada is getting a tariff of 35% on non-USMCA items, up from 25%. So I think what we're seeing is the president following through on some of these pledges that he made, that if you don't do a deal with us, then you're going to get you're not going to get the most favorable rate. And he's using geopolitics in this as well. There's a sense that what he's trying to accomplish with geopolitics is getting the tariff treatment more and more. So there's a lot of fine print yet to go through. The negotiations are going to continue. These tariffs don't kick in until August 7th. So there is time for countries like Taiwan that thought they were going to get a deal over the deadline day today, but they didn't. They got 20%. So there will be more tariff trade negotiations in Washington over the next week or so that will tell us a lot about how this is all going to affect the global economy.
Yeah, I think Terry Haynes put it well on your point about geopolitics, Brenton, that this isn't a trade war. It's a war that's using trade and tariffs as its tool. What does that mean for countries like India, for those like China, or even Brazil, where geopolitics or personal grievances are at play? What are the requirements that this Trump administration wants to see? What is the bar for getting a deal done?
Yeah, it's the Trump administration saying, I will hurt you economically if you don't try to meet me somewhere in the middle between issues like the Russia's war in Ukraine or the domestic political situation in Brazil that you referred to, and with China as well. There's this still outstanding deadline of August 12th, where tariffs snap back to much higher rates if they don't announce an extension of that. We would expect the president would do that. He had some nice things to say about how the talks went in Stockholm earlier this week, but we still haven't seen that from the president, and that's another big cloud hanging over the trade uncertainty is what happens next with China.
Hey, Brendan, thank you very much for your coverage all this week. That is Bloomberg's Brendan Murray. Let's stay on trade. And Nico Fitzroy of Signum Global Advisors writes, framework deals like the EU, one, are good for markets, but leaves real economy problems for industries. I'm pleased to say that Nico joins us now. He's a senior analyst and partner at Signum. Nico, so now that we have this list of trade tariffs, can we put it all behind us and move on, or where does tension still exist?
Yeah, I think with Trump, it's never really possible to put it all behind us and move on. I think if you look firstly at the tariffs that he has outlined over the last few hours, those have been kicked down the road in terms of implementation until August 7th. So we have another week of negotiations and trying to get deals before that. But also, if you look at the deals that have been agreed in the last few weeks, there are significant areas of uncertainty within those deals. It's still not clear, for example, with the EU and South Korea around the extent of agricultural export access for US exporters. If you look at the EU deal in particular, there are loads of areas that still need to be ironed out in terms of exemptions to those tariffs. And a previous deal that was agreed, the UK being an example, that took 7 weeks from the announcement of the deal till the announcement of full implementation, i.e. there was still ongoing negotiations around that for many weeks afterwards. So I think we can't put this all behind us. Even though we have had announcements, the implementation of it is still down the road. And even the deals that have been made will still require negotiations for minimum a few weeks, possibly a few months in many cases.
But Nico, I love this point you make that for the markets, it's a good thing that we have these tariff rates. It's the uncertainty we've been calling about that we can finally get some of that certainty. But as you note, for businesses and for corporations, it's not that simple. From some of the clients that you've been speaking to, where do they go from here? Are they still in a moment of being frozen, trying to understand how to negotiate, or do they just push forward?
Yeah, so I think the key thing, markets, this is always a key thing, but also for corporates trying to make decisions around investment, the key thing really is to know exactly what the tariff level is going to be for a prolonged period of time. Without that certainty, it's really difficult to make any decisions. And so the reason it's better, I suppose, to have a 15% base tariff for some of these countries or a 10% tariff in some cases, is that you then know that's what you're looking at over at least the next few months, hopefully the next few years, and you can make decisions based around that. So that certainty is useful because it gets rid of the volatility and it gets rid of the worst case scenario, which, in the case of the EU was 30% tariffs or even 50% tariffs. So by eliminating that worst case scenario and providing certainty, it's potentially a positive. But of course, we are still looking at much, much higher tariff levels that we've had in recent years. And I think the most remarkable thing over the last 6 months is how Trump has completely transformed perceptions of what is an acceptable level of tariffs. 15% base tariffs are now the level at which countries are agreeing deals with the US. If you'd said that 6 months ago, that would have seemed like a worst case scenario. That's now in many cases seen as a best case scenario because the alternative is 30%, 40%, whatever, much higher. So yes, certainty is good, clarity is good, but undoubtedly the real economy in many cases is going to suffer as a result.
It's such an excellent point that we were all anchored to a much higher level of tariffs, Nico. But some of the randomness of what we got yesterday, I think, has struck people, specifically for places like Switzerland, where no reason is given for 39% tariff. What did you make of that?
So I think there are a few countries like India and Switzerland that over the last few months there had been hopes from the US side, I think in particular, of getting a deal over the line. I think what Trump has often done is threaten much higher tariffs in order to try and extract concessions when a deal is potentially close to completion. So I think in terms of Switzerland and India would be another example. I think Trump is probably still hoping for a deal, and he's probably still hoping to extract concessions. And the reading of that may be that's why he's threatened these higher tariffs against some of these countries, rather than he wants to see Switzerland hit with a massive tariff permanently over the rest of his term, say.
Well, Switzerland's certainly hoping for a deal as well. Nico, so wonderful to catch up with you. That is Nico Fitzroy of Signum Global Advisors. A masterclass as always. Now let's get you some other top stories that are trending on the terminal this morning. Goldman Sachs credit strategists are urging clients to hedge risks. The yield premium on global investment grade notes have tightened to their lowest since July 2007. Goldman economists still expect the Fed to cut interest rates by 25 basis points in September, October, and December. Bridgewater founder Ray Dalio has sold the remainder of his stake in the hedge fund and left its board. A Bloomberg source says that Bridgewater bought the remaining shares. The source also said that Brunei Investment Agency, a sovereign wealth fund, invested in the company, giving it a nearly 20% stake in the firm. And TSMC's stock is reigniting concerns about the euphoria surrounding AI that it may be overheating. The price gap between the firm's ADRs and its Taiwan-listed shares surged to its widest level in more than 16 years. The ADRs trade at a premium due to not being included in the U.S. indexes, but are not usually at this wide of a gap. Coming up, President Trump demands that drug makers slash their U.S. prices. That sends shockwaves through the pharma industry. We'll have more on that next. This is your Bloomberg Brief. I'm Danny Berger in New York. European pharma stocks are taking a hit this morning. Drug makers have received letters from President Trump demanding that they will charge the U.S. what other countries pay for new medicines. U.S. drug makers also falling in the trade. For more, we are joined by Bloomberg health reporter Ashley Furlong. Ashley, what does this all mean? What does the Trump administration want from this industry?
So Trump wants what he's long been calling for, which is lower US drug prices. And the rest of the world does pay much less for their drugs. And Trump wants to peg US prices to those prices. How he's actually planning on doing that is initially through Medicaid, and then he wants to move that to all new drugs that are launched on the US market, Medicare, Medicaid, and through insurance-based systems. So that would be pretty significant for the industry, and we have seen the stocks down this morning in Europe. But what's also quite interesting is that the hit hasn't been potentially as significant as we might have expected in terms of those shares being hit.
Well, I was going to ask about that in specific, Ashley. How much of this, because I'm looking at some of the U.S. drug makers, they're down, but not hugely, down 0.5% for Eli Lilly, Pfizer down just more than 0.5%. How much of the reaction, what we're seeing, is the tariffs being implemented on Switzerland, and that also a method for really damaging some of these drug makers and trying to get them to the negotiating table?
Exactly. There's a lot of questions about whether this is just about getting drug makers to the negotiating table, and potentially if this is also about pushing European countries to lower their drug prices. And what's also on the table is whether drug makers will take the government to court around this. So previously, during Trump's last term, he proposed something very similar, and that was blocked by the courts. So there is a question around whether this actually might even be able to be implemented, or whether this is a threat to sort of extract further concessions from the industry.
What does that mean in terms for drug prices in Europe if something like this does go through?
So the expectation is that drug prices might increase in Europe, and they are low across the region, and that would be significant for health budgets, which don't actually spend that much on medicines comparatively to the US. But it would also come up with a lot of pressure from European governments who say that they can't spend more on medicines at the moment. So there's a lot of questions about whether that actually will happen, and whether Trump will be able to push drug makers to extract those concessions from European governments.
All right, Ashley, thank you very much for that latest. That is Bloomberg Health reporter Ashley Furlong. And we are wrapping up a big week in tech earnings. Shares of Apple are higher in the pre-market this morning by 1.75%. It reported its fastest quarterly revenue growth in more than 3 years. CEO Tim Cook spoke on the earnings call saying, quote, "We saw an acceleration of growth around the world in the vast majority of markets we track, including Greater China and many emerging markets." Joining us to break down those earnings is Valerie Taitel. Val, what was the takeaway from Apple?
Look, a beat for their iPhone revenue coming in strong, not just in the U.S., but also in China. They also gave some positive guidance, Danny, for the current quarter, which seemed to have been cheered by investors. Now, most people were looking at Apple as maybe a sign that tech is in some way being hit by tariffs. We did hear from the CEO that they expect the current quarter tariff bill to reach $1.1 billion. But they did try to convince investors that their beat in iPhone sales wasn't just driven by pull forward by those customers trying to front run tariffs. They did give a number. They estimated that around 10% of their iPhone sales revenue for the previous quarter came from that front running of tariffs. It looks like from the market reaction, the market is pretty happy with what it heard from Tim Cook and the bottom line of these results today.
Yeah, again, Tim Cook saying only 1 percentage point of that 10% overall growth coming from the pull forward. So that was Apple. Investors cheering that. Amazon, a different story, Valerie.
A different story for Amazon. They, in some way, started to spook investors' fears that maybe this CapEx spending on AI isn't paying off or isn't paying off as quickly as they would like. When it came to their Amazon Web Services, this is their cloud business, they did not give very decent guidance in the previous quarter. Revenue from the cloud business also was not as strong as expected. Now, Danny, this might be, kind of a tale or a tell for those other firms, other Mag 7s who are really, really investing heavily in AI. If they don't show current investors that that's having already an impact of their bottom line, it's something the stock could be punished for. And that's what we're seeing with Amazon today. Now, note that their cloud business, it does trail behind Google's cloud business and Microsoft's cloud business. But I think the fear is now that they're losing their footing in that very competitive market.
Valerie, thank you so much for that. Bloomberg's Valerie Taitel. Coming up, President Trump's tariff blitz. We're going to have more on that and what else are making headlines this morning. We're going to break down your front page news this morning as U.S. futures fall nearly 1% after that tariff list, after some of the disappointment from Amazon earnings. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning and what is making headlines across the top papers. And I should say, basically everybody on their front page is running with the new tariffs. With Donald Trump, the president, announcing a new slew of rates, the baseline rate will remain unchanged at 10%. Countries with trade surpluses with the U.S. will get 15%. Tariffs on Canada will be increased to 35%, but there are USMCA exempt goods. But Mexico gets a 90-day reprieve. China also gets that reprieve as well. Next up on the Wall Street Journal, big tech's AI spending spree. Google, Microsoft, Amazon, and Meta are all set to spend nearly $400 billion this year on capital expenditures. Morgan Stanley projects $2.9 trillion in spending over the next 3 years on chips, servers, and data centers. On the other end, nearly 100,000 workers at the companies have been laid off since 2022. And on the Washington Post, an exclusive on the Smithsonian's Natural Museum of American History to removing references to President Trump's 2 impeachments from an exhibit display. A temporary label including content about Trump's impeachment had been on display since September of 2021. Now the exhibit notes only 3 presidents have seriously faced removals. All right, let's get a look at currency markets this morning because there is an impact from what we saw of a 39% tariff on Switzerland. You can't see it now, but the Swissy, if we can pull that up, the Swissy is weaker by about 0.5% versus the dollar. It's notable because usually that is a currency which is seen as a haven in times of stress. That's not what's happening. Instead, you are seeing a dollar which continues to rise. This morning, the dollar, Bloomberg dollar spot, is up by 0.2%. Is it a reemergence of the exceptionalism, of U.S. exceptionalism? We are on track to see the strongest week for the dollar since September of 2022. It's a revival that's also accompanied new highs in equity markets, although that has taken a breather. Okay, coming up, economists forecast 104,000 jobs were added in the U.S. in July. Citi's Veronica will be joining us next. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The new tariff list unveiled. U.S. rates on goods across the world are set to rise to the highest level since the 1930s. It's Jobs Day in America. Traders await the latest data for clues on where the Fed goes from here. And a mixed bag for tech. iPhone sales lead Apple to strong results, but Amazon underwhelms. Well, here is your start to August, probably not the one you were hoping for. We're on the lows of the future session this morning, down by 1% for the S&P. The Nasdaq goes down to 1.1%. We have seen stocks hit all-time highs this week, only to now track for a fourth consecutive day of losses. The S&P also ended the day negative yesterday. Mixed results from both Apple and Amazon. Apple does better pre-market, Amazon does worse. Yields yesterday were higher after another round of stronger data, but payrolls will dominate the narrative today. 104,000 is what we're expecting, a 4.2% unemployment rate. Mike McKee will break that down in just a moment. But first, let's look at some of the stocks moving underneath the surface. Here with that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start there in the big tech. As you were mentioning, disappointment for Amazon. Those shares are down nearly 8% in pre-market trade with some weak guidance when it came to revenue numbers for their Amazon Web Services. That's their cloud business. Now, how that stacks up with the beat that we heard from Alphabet on their cloud business and the beat from Microsoft is starting to spook investors. Why Amazon isn't seeing that kind of growth, even though you could argue they are investing and spending just as much as the other Mag 7. Let's stay in Mag 7, move on to Apple. A bit more of a positive picture here, Danny, with the beat in iPhone sales coming in strong in North America and in China. We're seeing Apple rise 2% so far in pre-market trade. Also some language when it comes to their tariff impact, their current quarter tariff impact. They're guiding at $1.1 billion. It seems investors are not spooked by that big number this morning. Apple shares in the green. Lastly, I want to head over to Europe. We did have quite decent declines in U.S. pharma stocks yesterday on the back of Trump threatening or at least pressuring these companies to lower drug prices in the U.S. We have seen many of the European drug makers in the red. The big one, AstraZeneca, down 3.3%. Novo Nordisk down also more than 4%. Now, note that, Danny, these threats do come alongside the sector waiting for these sectoral tariffs on pharmaceuticals. So not only do we have the tariff threat, but we have the U.S. president pressuring these companies to lower prices, which is seen as not good for these companies' valuations. Danny.
Valerie, thank you very much for that roundup. Valerie Teitel. Now let's get back to our top story. President Trump sets a 10% minimum global tariff. Imports from countries with trade surpluses, meanwhile, in the U.S. will face duties of 15% or higher. Joining us now is Bloomberg's D.C. breaking news editor Kasia Klimanshinska. And Kasia, a lot to sort through. What is the takeaway from the past 12 hours?
Good morning. Indeed, Danny, a massive announcement from the White House yesterday, just hours before this deadline that President Trump set. And he said, indeed, the lowest possible tariff is 10%, mostly for the countries that sell to the U.S., less than they buy from the U.S. Now, for other countries, it is 15% or even more. For example, for Switzerland, for Swiss watches, Swiss chocolate, it will be a 39% tariff. For countries that were in talks with the U.S. or managed to strike a deal like Japan, the European Union, South Korea, is 15%. Most of those tariffs will kick in on August 7th. But President Trump also said that more announcements are coming, announcements on specific sectors, for example, semiconductors or chips, pharmaceuticals, lumber, and other products. So perhaps more to come, and tariffs are already up.
Kasia, thank you very much. Bloomberg's Kasia Klimanshinska. Now, along with today being the tariff deadline, it's also a big day for data. It is July's job report that comes at 8:30 a.m. New York time. Economists are forecasting 104,000 jobs were added. Joining us For What to Watch is Bloomberg's Michael McKee. Mike, what are you looking out for?
Well, I have a little bit different list than yours. We all start with the same number of jobs, but as the news changes, we look at different things underneath the hood in the report. Obviously, we're looking at the 104,000 jobs. Are we going to get a low number like that? Wall Street, interestingly enough, for the first time since March, is looking for a stronger report than the economists we survey. They're looking at this point for 120,000. We'll see if it turns out that way. But then the private jobs number is something to watch for, because last month we got 147,000 jobs. It was a surprise beat, but 74,000 of those were in government. And that should reverse. A lot of that's probably seasonality. And of course, the Doge people have been going through and firing everybody in Washington. So we'll see how many private sector jobs are created. The unemployment rate is also something that everybody is watching down at the Fed. It's not so much the level. If it goes up to 4.2%, they're not going to panic. It's the speed at which it starts to rise. You get to 4.5% by September, then there's going to be a lot more pressure to cut rates. The other final thing that you want to look for perhaps is labor force size. How many people are in the labor force? Because we've got this immigration issue. There are two questions. One is the labor force shrinking because nobody's coming in. We're not getting any immigrants at this point who are joining the labor force. And two, are a lot of people staying home, even if they're here, not looking for jobs because they're afraid of being arrested and deported. If that's the case, if the labor force size is shrinking significantly, then the unemployment rate might not rise as quickly, but it makes it harder for companies.
All right, Mike, thank you very much for breaking that down, that labor force participation, a very interesting point. Thank you so much. And of course, Mike will be breaking down the data later today, 8:30. Also, Mike will be speaking a conversation you do not want to miss with the Cleveland Fed President Beth Hammack. That's at 9 a.m. on Open Interest. Joining us now, though, around the table is Veronica Clark, U.S. economist at Citi. She expects payroll growth to slow to about 100,000 in July. Veronica, great to see you this morning. Thanks for joining.
Thanks for having me.
So you're about around consensus. Is there any reason to believe that there could be a wide deviation either to the upside or downside today?
Yeah, absolutely. I mean, we've seen consistent strength in these jobs numbers. So in that sense, we won't necessarily be surprised if we get another strong reading. That has been the trend. But there are a lot of fundamental reasons to think that job growth should be slowing. A lot of idiosyncratic issues, I think, also starting to impact the data maybe as soon as this July number. There have been changes to immigrant work status for recent immigrants. That could start to impact data as soon as July. Of course, this seasonality issue that Mike McKee mentioned, that seems to have to do with education, maybe shifts in the timing of school years. Of course, the government job loss and such, maybe that happens more in the fall, but a lot of reasons to think that there could be downside to this reading.
I mean, the thing is that very reasonable people can look at the data we've gotten so far and come away with two completely opposite pictures. On one hand, it is a resilient jobs market. On the other hand, there are cracks that are starting to form that will come up to the surface.
Yes.
Where do you stand on this?
I think I'm more worried about the cracks. It is still true that the headline numbers are strong. They've been really resilient. Of course, payroll, job growth. We do know that maybe that has some measurement issues. Chair Powell even mentioned this on Wednesday. We could see those revised lower in the official revisions we'll get later this summer. The unemployment rate, though, has been incredibly steady. It's been in this low 4.0, 4.2% range. Part of that, though, does, I think, have to do with falling participation. That has limited, how high unemployment will go. If you do look at something like continuing jobless claims, those are at new highs, would suggest that there has been a further pullback in hiring, and maybe the unemployment rate should be even higher. The reason that participation dropped in June actually was a really large exit of people being discouraged. So you've just given up looking for work. That doesn't speak to strong labor market to me.
In terms of the labor force participation and immigration, it's already been quite high numbers of deportations in this country and sort of the self-deportation. It's not as high as the Trump administration wants. But are we about to enter a period of a supply shock in this labor force? And what exactly does that look like? Yeah,
it's really hard to know how much has already been presented in the data. A lot of it will depend on how well is it being captured in these surveys, how well are people answering the government survey. And so I think there's maybe been some of that. We would, of course, get more worried if there were to be even bigger deportations. in the next couple months, there's something in the order of 800,000 workers who came within the last couple years who might lose legal work status. That sounds like a big number, but there might be other legal means that they could be working. It's just really hard to know at this point.
We also had a challenger job cut announcements yesterday that was much higher in July, a 140% increase year over year. And it was the tech sector that led with the most cuts announced, more than 13,000. Is this starting to have a real impact of these tech companies saying, we're shifting our workforce, and that means a reduced workforce as we concentrate on AI?
Yeah, those challenger numbers are interesting. They're really hard to base any kind of forecast on, but they're interesting to watch maybe for dynamics, if there's a consistent trend. They do job cuts by reason, and there was a big increase in job cuts because of AI in that July number. So that is interesting to watch. I do wonder if so far that AI story has had more to do with low hiring. If someone does leave, you're not replacing them. Maybe AI is improving productivity there and not so much on the job cuts. It could be a more dramatic story if it's changing, but 10,000, that's still small in terms of the overall labor market.
Veronica, there's so much to grapple with, and while you're here, we have to talk about what we got yesterday, about the various tariff announcements. It looks like the average level will be something around the highest since 1930s. It's a market that perhaps is shrugging it off. I mean, we are down this morning, but because we were anchored to a much higher level, as we start to get these numbers in, how do you sort through what the economic impact is? How do you even begin trying to calculate it?
Right. It's really difficult. And as economists, what we want is a historical scenario that we can base our forecasts on. And we don't have that in this episode. This is a very different economy than the 1930s, of course. So we'll have to see how it plays out. I think the market is maybe a bit dismissive because we haven't seen a ton of impact on the economy so far. To that, I think I would say it's just too soon. And there has been so much uncertainty around the tariff rates themselves. Businesses have inventory that maybe they're drawing down. You're waiting as long as you can to get more clarity on the tariff rate. Are they actually going to go into effect? Are there court orders that are going to walk some of this back? That you're going to wait as long as you can to raise prices or shift production schedule. But if these tariff rates, are what we're going to be facing in the next year or so, I imagine we're going to see a bigger impact on prices and activity.
But I guess the question is whether it's just a slowing of growth, whether it's just cooler and we kind of bump along, or whether it looks something more pernicious. How do you decide where the kind of where the split leans towards?
Right, we're coming down right now that it could be a more gradual slowing. Of course, so we are coming from an economy that was already gradually slowing going into this year. Probably has to do with rates that are restrictive. We see that weakening in sectors like housing. The easiest way that we're trying to think about the tariffs is that it's a tax increase, right? So what, as a share of GDP, is the revenue raised from these tariffs going to be? And if that acts like a tax increase, what does that do to the economy? Something like 1% on GDP. Maybe the drag is even a little bit less than that, just a couple tenths. Obviously, not all domestic consumers or companies are paying for this. Some will be, exporters paying for it too. But we really don't know. We're going to be bad at forecasting this.
I think that is very humble of you to say, and I think that is the case for literally everyone. Veronica, so wonderful to have you on. Thank you so much for joining. That is Veronica Clark of Citi, and again, that data for jobs drops at 8:30 a.m. Eastern. All right, let's get you some other top stories now trending on the terminal this morning. Goldman Sachs credit strategists are urging clients to hedge risks. The yield premium on global investment grade notes have tightened to their lowest since July 2007. The economists at Goldman still do expect the Fed to cut rates by 25 basis points in September, October, and December. Bridgewater founder Ray Dalio has sold the remainder of his stake in the hedge fund and left its board. A Bloomberg source says that Bridgewater bought the remaining shares. The source also said that the Brunei Investment Agency, a sovereign wealth fund, invested in the company, giving it a nearly 20% stake. President Trump has been meeting with heads of major U.S. banks to discuss monetizing Fannie Mae and Freddie Mac. Bloomberg sources say that this could include a major public offering of stock. J.P. Morgan's Jamie Dimon and Goldman CEO David Solomon have met with him at the White House. Fannie and Freddie have been under government conservatorship since the 2008 financial crisis. Coming up, Apple and Amazon round out the big week in big tech earnings. Joel Kulina of Wedbush Securities joins us next. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in New York. Shares of Apple rising in the pre-market after strong third quarter results. Joel Kulina of Wedbush Securities writes, quote, long-term uncertainties around Apple's competitive positioning feel like they remain as high as ever. Without AI being a part of the narrative in a meaningful way, the bears will continue to think that multiple has more downside than upside risk. I'm pleased to say that Joel joins us now, Managing Director of TMT Strategies at Wedbush. Joel, so a lot to pick through. We also had Amazon earnings, but let's just stick with Apple for just a moment. The results were strong, and we had a Tim Cook who said only 1 percentage point of Apple's 10% overall revenue growth came from a pull forward in sales. How much trust do you put in that number and the ability of Apple to continue the growth that we saw?
Yeah, that's good morning. Thanks for having me. Yeah, that's the million-dollar question, right? Like, obviously, Cook sounded pretty confident on that number that he threw out on the call. But I do think it's pretty hard to kind of quantify that type of number and say it with really any sort of conviction. So I think we'll see maybe as kind of this year progresses in terms of the pull forward effect. But again, for Apple, as you kind of mentioned, and people are fully aware, it's probably the number one stock that mutual funds are underweight. It's been a hedge fund funding short for the better part of the last 5+ years. So, I mean, positioning expectations were extremely low heading into the print. And you know what? Revs came in up, top line beat 9.6%. Buy side was at around 6% beat. China grew 4%, which obviously is a big focus of the narrative there as well. And Cook did his best to kind of support and pump up the AI narrative on the call, threw out a lot of buzzwords. But the reality is, until AI becomes a meaningful part of the narrative and the story for Apple, and there's tangible revenues attached to it, I think the stock's just going to sort of languish kind of in the near to medium term.
Well, we made clear that they're really trying to reorganize things to put the emphasis on AI. But Joel, when there are reorganizations in companies, what tends to happen is talent jump ship. And they're especially more likely to jump ship if big old fat paychecks are being dangled in front of them from the likes of Meta. How much longer? What does that mean for the timeline if Apple is losing a lot of the talent in order to get the AI push done that they need?
Yeah, that's a great point as well. I mean, you go back to earlier this year, Mark Zuckerberg, when he did his podcast circuit, in January, February, he was very adamant that this year is critical for AI. And he's obviously flexing his muscles as much as he can, not just for the company's CapEx commentary, which is massive, especially for 26, but yeah, poaching talent and giving out sort of pro athlete, multi-strat type of pay packages to engineers. And they're not messing around. And obviously Meta's poached a ton of talent from Apple. So as you said, that timeline is getting pushed out, and which makes you think for Apple to kind of take this seriously, we're going to see some sort of splashy M&A. I know my colleague Dan Ives, who's been on top of this trend probably earlier than most, he's thrown out Perplexity and as have others. So people want to see something sexy here from Apple, and they got to figure it out.
Well, maybe we got something sexy from Amazon, but maybe it was too much. I mean, they're still spending over $300 billion, at least they did in the quarter, on capital expenditures. Joel, it's been fascinating to look at this market decide what is okay in terms of spending and what is not. We decided it was not okay in terms of Amazon because some of the results didn't show up for AWS. But Joel, is this a company that should pull back on spending? If they don't keep up the pace, even if their earnings aren't great at this moment, doesn't it mean that they will be losing out?
Yeah, I think sort of the jury's out on that, but you make a great point. Yeah, Amazon's free cash flow, I think, came in around break even, and kind of the street was closer to 8.2 billion. So that's an issue, especially when AWS came in at 17% growth. Meanwhile, Azure put up 39% growth. Google was in the 30s as well. So they are trailing their peers significantly here, and it's not coming through in the numbers. And sort of the stock's going to definitely just kind of chop around here, if not downside risk. And that's the million-dollar question. Why is AWS not growing faster? They're clearly spending. They can't afford to kind of pump the brakes on spending either, given what their peers are putting up. But it sort of begs the question: what is happening with AWS specifically? Are they losing share? Are they investing in the wrong areas? And then sort of Amazon overall, it's just a lot hairier of a story than Meta, Microsoft, Google, and NVIDIA. You have the retail portion, their exposure to the consumer, outsized exposure to tariffs as well. So there's just always been a lot of moving parts for Amazon, and hence it's probably going to kind of languish and be firmly, 5 out of 6 in terms of the mega cap rankings, at least in terms of positioning goes.
Joel, you talk about this idea that they need to keep up with the spending. And at what point Do we just see these companies spending for the sake of spending, trying to one-up their competition, keeping up with the Joneses? Joel, the logical conclusion of that is that someone just takes it too far, or multiple companies take it too far. When we don't quite yet know what the payback is going to be from all these investments, what are the risks in that?
Yeah, the risks are sort of a repeat of what we saw 20, 25 years ago. I was a little bit too young to kind of have my finger on the pulse back then. But I mean, yeah, that's a real risk. We've had recent reports where Microsoft's been moderating on their CapEx spend. We've had reports, Stargate is also kind of trying to figure out their spending regarding some of the pledges that they made earlier in the year as well. Again, it's sort of one of those things, time will be the jury of how this all plays out. But again, look at even Reddit this morning. Stock's up 15% in the pre-market, and they were talking that AI is really boosting their performance. We heard the same from Meta, as well as some other kind of companies as well. So if there's tangible, evidence being, provided that AI is driving performance, it's driving revenues, companies will spend. And I think Microsoft and Meta, a couple nights ago, are proving that. And until that sort of goes pear-shaped, I think you'll see the spending continue.
All right, Joel, thank you so much for getting up early and joining us this morning. We really appreciate your time. Joel Kulina of Wedbush Securities. Coming up, we are in the thick of U.S. earnings season. We're going to get big oil results on deck. Lizzie Burden is going to show you what you need to know with your trading diary. That's coming up next. This is Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Let's take a look at what's ahead today. Before the bell, we're going to get earnings from Exxon and Chevron. Then at 8:30 a.m., we'll get the July payrolls report. And then at 9:45 a.m., we'll get S&P PMIs ahead of that US ISM manufacturing data at 10 a.m. New York time. Let's also check in on your micro movers. We have Amazon shares slumping in pre-market after investors got spooked by that company profit outlook and cloud growth figures. Meantime, Apple delivering, that stock rising in the pre-market after posting a growth rebound. And we have Coinbase shares plunging on disappointing revenue driven by lower sales volumes. A look at your macro movers as well. We have S&P futures pointing south as we head towards the Wall Street Open. The Bloomberg Dollar Spot Index is up 0.2%. July, of course, the first monthly gain for the dollar since President Trump returned to the White House. And you're looking at your 10-year at 4.38 as we head towards that jobs report. All important later on in the day. But that's it for Bloomberg Brief. I'm Lizzie Burden. Surveillance will take it from here. This is Bloomberg.